Today, we talk about tax tips won by a business. So it is very possible right now, you're thinking of, I want to buy a business. Maybe you already have a business, then you want to buy additional part of the business to join your business. So however you buy, there's only two simple ways you deal with it. And you either buy the item, like the asset, right? You buy the stove, you buy the building, and you buy the piece of land. So you actually buy the thing. But there is a totally another way of buying business, which is to buy the stock. But today, for this 30 minutes, we are going to focus on buying the business, buying the assets. So a lot of time when you look at your contract, your purchase agreement, or someone wanting you to buy them, they give you one from their attorney, and you will see on the topic, they say asset sale. What does that mean? That just means that they're not selling you their shares. They're just selling you everything they have in the business. A lot of times folks think that that's the same. In actuality, a lot of time it's the same because if you buy a grocery store, for example, and you continue the lease, you continue the inventory on there, and you also buy the freezer, walk-in cooler, all of these things, right? So you felt like you bought the business. But just by saying, oh, I bought a business, that doesn't explain whether you bought an asset or you bought that business shares, right? You could buy 100% shares, then the whole business is yours. But you could buy 50% of the shares, then you become half of the owner. In my earlier last week, I talked about how to accept a new partner. So that has a lot to do when you come into the business or when you becoming part of the owner, what you need to consider. But here today, we are going to focus on we're buying this grocery store, we bought the lease, continue for another 5 years. The lease says that. And we bought the cooler, walk-in cooler, and we bought the counter, bought the shelf, we bought everything inventory all included, $1 million. So today's focus is that how is this have anything to do with tax, yin and, whether I buy them or not buying them in that way or this way. And I already know I spent $1 million, so that's all what it is. No, when you buy asset, it is really important you actually know how to break the asset down because you want the asset to be labeled by each item. When you add them up, they come up with your total purchase price. So let's say you bought it for $1 million. Then maybe come with that 1 million is a $500,000 worth of the building. So you're gonna give the 500,000 to the building. And even with that building, you're gonna break them down at least for 3 sections, if it is not more, because land, building structure, building components, they're just all different. Why do I really care about getting them break down so in depth? And what's the deal? The deal is when you break them down and you write them off differently. If you give your whole $1 million into land, you cannot depreciate anything. So you run the business for a year, you go, oh, now time to pay taxes. And you will suddenly realize that, well, I spent $1 million. How come I cannot deduct $1 million? Of course you cannot, because the land is not depreciable and you cannot deduct any dollar out of the land. If you allocated all your millions to the land, you're going to end up with no deduction, right? So what I'm trying to relate to you is that you actually need to break it down so we can classify those assets by the year the asset would last. For example, you bought this building. Using building is easier because the building structure, the commercial building structure, And that would depreciate over 39 years. So you're going to divide that by 39 and take 1 year as your expense, right? So, but building components is all different. If you bought a refrigerator, that depreciate differently from you bought the windows. If the windows are so bad you can replace them for in a year time, then their depreciation years should only be a year. Am I right? Because you really not gonna last it for that long. So with what I said here, kind of give you a clue. Am I right? So when you buy a business, and other than you want to buy it in a good price and bargain it hard and you got it. But once you got it, your job is to break it down to each asset in such a detail that you know that you're going to maximize your deduction. So you're not going to be paying $1 million, not able to deduct anything. You're going to be paying $1 million, maybe you can deduct $450,000 worth of it. That would help you with the first year operation. You made money, but you also have a large depreciation expense, right? So when bonus depreciation was here, everybody's excited because the building components, like the stuff I was talking about, windows, roof, and all of that stuff, it will be depreciated right away because they're under 15 years life. But now that is sort of going away. This year, 2024, is only 60%. So Section 179 is another way of depreciating things. It's coming back to us, right? It used to be there very conveniently for folks, but now it's coming back because it is needed to use it, especially if you made profit and you can utilize Section 179. So I did a lot of general talk already. The reason is that I really want to bring home the thought of, okay, when I buy properties, when I buy a business and there's no big deal and I can just do whatever I want. No, it is really a big deal because you want to plan. Okay. And so let me start quickly showing you the slides that I prepared for us when I scheduling for today's session. So I'm going to share screen now, and I will bring you the large screen out. So this is us, right? This is the tax tips when buying a business. So I'm kind of going backwards a little bit, but you know about our firm, and this is the 2 books I wrote. It's really, it's a business story. So if you're into to do business, you read all the other people's book. I highly recommend the book that I wrote. This one will give you the very down-to-earth, small, medium-sized businesses story, and plus my own with community CPA, right? There's a lot of CPA firm out there, but you happen to know community CPA. In your own mind, you know the difference between the other CPA firm and this one. So that difference and in business is called the business character. So when you have a very elite, different, fresh business character, and then you actually can do business better than other people when they don't have such a character. So with that said, one of the big character that you should have, which we have, is the thirst in learning. And I care about learning. If I have any time spare, and I would get on internet, I would get on podcast, I would get on anything I know that related to CPA firm business, and I will study. So same thing, when you want to buy a business, when you want to buy asset, and you are into a business journey and you need to study, and very important. So coming to this webinar is actually a good idea. And of course, information is so fluid. Make sure you take those knowledge responsibly and do not just, oh, my friend said that doesn't work. And it sometimes it frustrates us secretively. We don't really tell you. When our client come back goes, my friend said that he make a lot more money than I do, but he doesn't pay taxes. How come I pay so much taxes? So it is It is $1 million question. And it's not as easy as us to say that, oh, your friend is wrong. But what I can tell you is someone can get away from doing something and still doing it wrong way. That doesn't mean it is right way. It just means that he's lucky, right? He's lucky. He's not being monitored. Nobody is really looking at him, so he get by. He may get by forever. That's just a lucky person in the way. But you don't want to do business based on luck. You want to do business based on what you know and knowing that you are doing the right thing so you can create a not only just a business and a legacy that gonna last forever, right? So that is kind of the attitude we have related to that. So a lot of purchase and the merger is coming through the pipeline. And if you're sitting at my chair, you know it. And I know as an individual, you're just running your business. You may not see your friend selling their business. You may not see your friend buying other people's business. So in your world, you are not aware of that. But I will tell you, it's everywhere. And it's like the rain in the spring. It's just everywhere. And I don't know. Some people say it's because of the downturn in 2023. I actually didn't feel like 2023 was a downturn. I just felt like 2023 is sort of stretched out to unknown, a year of unknown. People are not sure where economy goes, and there's recession prediction. There's also inflation going on, so people not knowing what to do. So 2023 was sort of flat, but right now things are not the same. And I would say that if we don't have an election going on this year, it will be a year that activity will be very heavy. But because of elections, so adds a little bit of uncertainty, but business merger and acquisition still going on, and it's going a big deal. So if you are wanting to listen to me because you are going to buy business, you are just one of the normal ones, and that's what is doing things right now. So it is not anything different, and you just need to understand this is the business trend. You're kind of riding the wave right now. And just like I said, you buy business, you buy asset, or you buy the ownership, right? So today we focus on asset and a purchase asset, and you want to understand the tax basis and asset purchase tax basis. This is something you would need to understand. For example, you understand, so what are the amortizable asset, what are depreciable asset, what are not depreciable asset, like land. I was talking to you, right? So you understand that. Then you also want to know that after you bought it, if you sell it, right? So because you depreciated that, right? So when you sell it, it would have recapture gain coming to you. So, I would recommend business owner that if you are buying asset, and when you are buying the asset and you meant to use it to grow your business, so someone will come around and goes, oh, depreciable assets is no good because you end up paying capital gains. I always tell folks that in tax world, in business world and tax world, and we don't need to consider futures that far away, and especially with taxes. And it goes on every 4 years when there is a change of White House residents, and then you would end up with different tax strategies. Maybe it doesn't come to fruition right away, but during the 4 years, it will become reality. So I always say that for tax world, folks, you don't need to be thinking like financial planners who give you some ideas of doing what in the 20 years later. You just need to think of 2 years, 1 year. So really, when you buy asset, just make as much as of them to be depreciable asset. You don't care about when you sell. When you sell, the policy might be different, tax code might be different, and your situation might be different. And you may be in the situation where it's okay to have some income because you don't have to pay a lot of taxes anyway, right? So just don't even be too bothered. Don't let your today's decision be influenced by the imaginary future. So I have people talking about, you know about Roth IRA, you do, right? So you pay taxes right now, and then you put the money in your Roth IRA account. So, when you take it out, when you retire, it's tax free. So attractive. So if you pay 40% taxes, you save so much plus the interest you made. Amazing. Of course, I understand that. But I will give you a monkey wrench right here. What if the state and the federal government are changing taxes for seniors? So when you become old, there's the taxes is reduced, taxes is exempt. How about that? And those are on the table, folks. So it is not me sitting here crazy imagining. Those things are becoming law every day, including state of Iowa. So with that said, do is it really a good deal to save for future tax rate where you using today's tax rate to do? And someone says that tax rate will be higher and higher forever. Is that really, really true? No. Corporation tax rate was not higher and higher. It went pretty high. It dropped into 15%. Now it's 21%. And so it didn't go higher and higher. It actually dropped. So no, tax rate is a man-made matter. As long as the residence of White House changes, and the rate will change. Okay. But of course, if we had a kingship, someone just come in gonna be king forever, then maybe tax rate would not change anymore because that person will keep it that way, right? You hear me, you know what I'm talking about. So asset purchase result with a pass-through entity. So when you purchase asset into your business, if you're pass-through, just know that it is all reflected on your 1040. But if it is you buy it with a C corporation, like it's a corporation, it's like a separate entity, then this one is actually accounted in the C corp. It doesn't impact your 1040. And I know folks always say that, oh, Ying, I don't understand a pass through and not pass through. What's the big deal? The deal is if it is pass through, it is almost like a basket without a bottom. So whatever you put in is go dripping through, and you pay everything as an end result on 1040. But if it is not a pass through, it holds the basket bottom. So everything is treated inside of the basket. Okay. So, we always say that, S corporation 1065 partnership is pass through. C corporation is an independent corporation. And that's why when President Trump's business, he has many, many businesses, but some of his businesses would file bankruptcy, and those did not affect him personally. Uh, Disclaimer, I'm not his accountant. I was just logically understand what's going on with all of the things out there floating in the media. So I just reasonably put together and sort of knows how that structure goes. So in the C corp, you file bankruptcy, it doesn't affect you personally. So he can still live in the 31,000 square footage penthouse, and but have a company that totally written off all the debts and everything in there. So that is the benefit of having the C corp, right? Separating away from your personal. And those benefits are not just available to president, it's available to everybody. And as long as you know how to work your planning, right? It's not even work, you know, it is a strategy of taxes. It's not even gray area. That's just how it is, right? A tax smart purchase price allocation. This is what I was talking about. You just don't get your $1 million purchase price and plug them all in the land, then of course you're not gonna have any deduction, and you want to do it differently. You want to make sure that you allocate them and knowing which one is going to be depreciated sooner, quicker, and use your brain, right? If you bought this business with so much inventory and you want to evaluate the inventory, folks, so put money on inventory because they are directly going into your cost of goods sold. So you can reduce your profit, right? Of course, you can do appraisal. And if you don't believe that, we have a client who bought the property, and the you know the property price totals here, but how much goes to the land versus how much goes to the building. So our client would go ahead and get that appraised, so he will know what is the proper split, right? And plan ahead is really a big deal. And you want to plan when you buy asset in business. And I would encourage you guys that if you are in the process of buying a business, and I know, when you buy business is such a big paycheck, such a big check you need to pay out. You want to save money, you want to save everything to get that purchase through, right? And don't forget, there's so many things you can do. You can research for startup funding, and you can research for cheaper purchase. You can research for government programs that support the startup in your area and try to get free services that way. But come to taxes, come to your bottom line, come to your accounting and your payroll, all of these compliance driven business elements, you want to pay the professional to get a good job done. There's many other ways your good professional accountant would tell you what to do. They would have enough experience to do that for you. And this is where, I didn't realize that when I was younger. But with me approaching to my age group, now our firm has much younger people coming in, and I see the young people. What I have realized is that, as a small CPA firms, if the people are young, they just don't have enough experience to really understand the in and outs in the business, in the social setting. I mean social setting, not that they don't know how to talk. It is they don't understand a lot of intricacies, and okay, we can classify asset this way, but this client has a line of credit with a collateral based on account receivable. Did we want to give account receivable what value, right? So there's so much deeper thinking. Or this client and did not want to distribute a lot of profit over, and they want to keep that going in the company because they want to expand. So setting up different structures to facilitate that expansion, those kind of business experience, business social experience accumulation is not something anyone can learn in college or university. And or just being young and creative, that doesn't give that. So with that said, in the accounting world, a lot of time, the older the better do have a reason. I remember when I just started working on the accounting, I remember my supervisors at Bank of America, that was my first job, and they told me that, because they were promoting someone which a lot older than me, but I actually do a lot more work there. So I asked my boss that, how come you didn't promote me and you promote the other person? And his answer to me was the older the better. Didn't understand that right now. But I thought at that time, I thought he meant the older, the more respectful we should be to that person. So better to promote that person. So that's kind of how I understood that sentence. But now I understand it just simply because he has so much experience in the area, even though we're all doing the same thing, bank reconciliation, but the variety of bank reconciliation that he saw in his years compared to me will be a lot more. So that's why he get the promotion and he get be recognized. So this is the same thing. So you want to find your CPAs and your attorneys, whoever help you to plan ahead to have that experience. At our firm, obviously I founded the firm, so I started from almost 27 years. By now, actually 28 years by now. But we also have 40 other people. So if you add everybody's experience in here, we're more than 100 years old. So with that said, and I just want to give you a tip in terms of planning ahead, and you save everything anywhere, but do not try to save professional advices. You need that. The allocation process can lead to better or worse post-acquisition tax result. Isn't that true? So better just means if you allocate it really smartly, you're not going to pay taxes, even if you made a lot of money. But if you don't allocate that properly, and you will end up paying more taxes and not getting so much deduction. So that's just what we mean by that. And talk to community CPA if you are uncertain and got your advice. Get your advisor from community CPA involved early. Do not, already at the tax time, because when we allocate asset in terms of value, sometimes we need to coordinate that with the seller. The seller need to know how you allocated that, so we need to come to agreement because they also need to calculate their taxes. So the way you allocate may not be good for them. So that agreement need to be there. So it is a coordinating between buyer and the seller in come to there. And I didn't really show every one of our website, but this is our website, one page where you make appointment. We are so big with appointment, right? I have the book called Appointment at 8 a.m., Appointment at 10. You know, there was one time a client came in. Our office opened at 8:30, but we had an 8 a.m. appointment. So when they come in, they're like, "Oh, Ying, appointment with Ying at 8 a.m. Where's just the book?" They're the book because they are starting up a business. So it's quite interesting. And on our website, there's appointment button. If you click that button, you see us. And each one of us has kind of a specialty area, and you can actually click us and book time. And those are video conference. Once you book and we come on the video, and it's a fee-based service. And each one of other than myself and Dr. Hao, the other partners has a 30 minutes free consultation, so you can book for the free and then figure out what you want to do from there. um, Coming to book time with me, and then my rate is on the website, so you can actually follow through that. This is my last slides I want to uh, show you here, and we actually right now we're almost 6,000 subscribers, and this is our email, Catherine at communitycp.com. And Catherine, um, in charge of firms marketing, and she also is an amazing librarian. I say that because normally marketing folks are not, I don't expect marketing folks to actually know the content and drive the content. And a lot of the talk you see, if you're kind of intrigued with our topics, and that's Catherine. And so she talked to clients. She knows what would be interested. So she will talk to me about, okay, should we talk about this? Then we come up with the content together. But Catherine is really the one that you can give her tips to tell her what you like to hear. Then you will hear from us because that's how we work in our firm. We don't have a predetermined topics because we don't know how the world moves, right? During the pandemic time, we have a lot of pandemic topics, but now we have a lot of merger acquisition topics. So it just goes by the flood in the CPA tax world. And one other things I want to mention to you is our firm. We have 5 branches. Okay, we have one in Des Moines, one in Iowa City, and one in Bloomington, Minnesota, and Capitola, California, and Houston, Texas. So Houston, Texas is our latest one. We're still renovating the office space. I just received the drawing of the office space, so hopefully it will be done soon so we can start operating in Houston. And all of our branch, however, open 6 days a week. So we open Monday to Saturday, 8:30 to 5:30. And not that all of our folks, we still go by 5 days working week, but we have people work from Tuesday to Saturday and people working from Monday to Friday. So I hope that gives you a little bit highlight of who we are. And I appreciate your spending time with me and hearing what I have to share. And I appreciate you give us a thumb up for the one that you like, and also subscribe to our channel and keep us going. And we have met so many friends, so many clients and on the YouTube channel. And I cannot not to tell you, a lot of people recognize what we can do via YouTube channel. So I hope you also is a YouTuber and also liked us and subscribed to our channel. I'll talk to you again. Bye bye.